Welcome everyone. Today we will be discussing the pros and cons of the National Budget 2025 based on financial ratios from 2023 to 2027. By analyzing these key financial ratios, we aim to understand the strengths and weaknesses of the budget, providing valuable insights for policymakers and stakeholders. Let's go into the details. First, I am presenting key insights and the pros. Improving debt management. One of the key insights from our analysis is the significant improvement in debt management. The public debt to recurrent expenditure ratio drops sharply from 1.06 in 2023 to 0.27 by the year 2025 as planned. This dramatic decrease signals a reduced reliance on debt to fund recurring expenses, such as salaries and administration. Such a trend suggests that the government is making strides towards better financial health and sustainability, reducing the burden of debt on the economy. Debt sustainability. This idea focuses on debt sustainability illustrated by the public debt to total ratio. Total here is the recurrent plus capital plus public debt amortization. From the bar chart, we can observe a significant improvement in debt sustainability over the years 2023 to 2027. The public debt to total ratio halves from 0.47 in 2023 to 0.25 in 2027, indicating a healthier financial position. This decrease signifies that the government's reliance on debt relative to total resources is decreasing, reflecting better overall debt management and sustainability. Capital expenditure prioritization. This idea focuses on the prioritization of capital expenditure. We can see that the recurrent to capital ratio falls from 5.07 in 2023 to 3.93 by the 2027 projection. This decrease suggests a deliberate shift towards infrastructure and development spending over routine expenditures. By prioritizing capital projects, the government aims to enhance long-term growth and improve the country's infrastructure, which can benefit the economy as a whole. This idea is about reduced fiscal vulnerability. It highlights the reduction in fiscal vulnerability over the years 2023 to 2027. The public debt to recurrent plus capital ratio is projected to decline from 0.89 in 2023 to 0.33 by 2027. This significant decrease indicates that debt is becoming less burdensome relative to total budgetary commitments. As a result, the fiscal health of the national budget is improving, making it more sustainable and resilient to economic shocks. This idea is about improved debt management again. It highlights significant improvement in managing public debt over the years from 2023 to 2027. As seen in the bar chart, a decreasing trend in the public debt to recurrent ratio starting at 1.06 in 2023 and dropping sharply to 0.27 by the year 2025, that is this year. This decrease continues with projections indicating values of 0.36 in 2026 and 0.42 in 2027. The trend suggests that debt is becoming more manageable relative to recurrent expenses such as salaries and administration. This improvement indicates stronger financial health and sustainability in managing debt. Increased capital investments. This idea focuses on increased investments in capital projects. The recurrent to capital ratio is decreasing, as shown by the values in the bar chart. In 2023, the ratio stands at 5.07 and it steadily decreases over the years, reaching 3.93 by 2027 as projected. The 2024 ratio is 3.67, indicating a significant shift towards capital investment. The 2025 plan shows a significant increase to 4.50, but the trend continues downward in the subsequent years with projections of 4.24 in 2026. This decreasing trend suggests a shift towards more investment in capital projects, which can enhance long-term growth and improve the country's infrastructure. Reduced fiscal vulnerability. This idea highlights the reduction in fiscal vulnerability over the years 2023 to 2027. The public debt to recurrent plus capital ratio is projected to decline from 0.89 in 2023 to 0.33 by 2027. This significant decrease indicates that debt is becoming health of the national budget is improving, making it more sustainable and resilient to economic shocks. This is about lower debt relative to total resources. The public debt to total ratio shown in the bar chart halves from 0.47 in 2023 to 0.25 in 2027. This significant decrease indicates a healthier financial position as debt decreases relative to total resources. Such a trend reflects better overall debt management and sustainability, reducing the financial burden on the economy. I'm now taking you to key risks and cons. Aggressive assumptions are indicated here. The idea discusses the assumptions underlying the national budget projections, specifically focusing on the public debt to capital ratio. The 2025 plan shows an abrupt improvement with the public debt to capital ratio dropping from 3.03 in 2024 to 1.22 in 2025. Such a drastic change raises questions about the realism of revenue and borrowing assumptions. It's important to scrutinize these projections to ensure they are based on sustainable economic conditions rather than overly optimistic scenarios. We also see recurrent expenditure pressure. Despite improvements, the recurrent to capital ratios remain above 3.93 through 2027. This idea highlights the ongoing issue of high operational costs and could potentially crowd out growth, enhancing investments. Even with the deliberate shift towards capital expenditure, the persistent high recurrent expenditure indicates that operational costs continue to exert pressure on the budget, potentially limiting the resources available for capital projects and long-term investments. Execution risk in capital projects is another issue. The idea focuses on execution risk associated with rapidly rising capital expenditure. The chart illustrates the public debt to capital ratio, showing a significant decline from 5.37 in 23 to 122 in 25 as planned. However, the ratio slightly increases to 1.54 in 2026 and 1.65 in 2027. Such rapid changes in capital expenditure require strong project management to avoid waste or corruption, ensuring efficient execution and oversight of capital projects is crucial to achieving the desired outcomes and maintaining fiscal sustainability. The next point is about critical questions for policymakers. This idea highlights the critical questions that need to be addressed by the policymakers to ensure the realism and sustainability of the national budget projections. What structural reforms drive the projected debt reduction is a question. Are there specific tax reforms, subsidy cuts, or other measures that contribute to the anticipated decrease in debt? Next, how sensitive are these projections to external shocks? Factors such as currency fluctuations, global interest rates, and other external economic conditions could impact the projections. It's crucial to assess the vulnerability of these projections to such shocks. Next, are recurrent cost reductions achieved through efficiency gains or austerity measures? It's important to distinguish whether the reductions in recurrent costs are a result of improved efficiency and productivity or simply due to austerity measures that might have long-term negative effects on essential services. These questions, the three I mentioned here, are pivotal for understanding the underlying assumptions and potential risks associated with the budget projections. By addressing these critical areas, policymakers can ensure a more realistic and sustainable approach to managing the national budget. Of course, I mentioned about aggressive assumptions. The idea discusses the sharp declines in various ratios and the potential issues these declines may indicate. The significant decreases may stem from overly optimistic projections or one-time factors raising concerns about the sustainability of these improvements. It's crucial to scrutinize these assumptions to ensure that the budget projections are realistic and sustainable in the long term. Potential neglect of recurrent needs. This idea emphasizes the possible downside of focusing heavily on capital spending while investing in infrastructure and development projects is crucial for long-term growth. There is a risk that recurrent expenses such as salaries and maintenance might be neglected. Ensuring a balanced approach that adequately addresses both capital investments and recurrent needs is essential to maintain the overall effectiveness and sustainability of the national budget. Economic vulnerability is another issue. This idea highlights the potential economic vulnerability associated with the budget projections. The improvement in financial ratios may rely heavily on stable economic growth. Any economic shocks such as currency fluctuations, global interest rate changes, or other external factors could jeopardize these projections. It's crucial to consider these vulnerabilities when assessing the sustainability of the budget and to have contingency plans in place to mitigate potential risks. This idea is about uncertain debt stock. While improvements in financial ratios are promising, this idea emphasizes the importance of considering the actual debt amount. If the debt amount remains unchanged, the positive outlook might be misleading, driven by factors like increased revenues or GDP growth rather than genuine debt reduction. It's crucial to assess the true debt stock to ensure the fiscal health and sustainability of the national budget. So, finally, the key insights we gain here. Three crucial insights from this analysis of the national budget. Increased capital spending and improved debt management is clear. There is a clear trend towards prioritizing capital expenditure and enhancing debt management, as evidenced by improving financial ratios over the years 2023 to 2027. There is a caution regarding realism of future projections. While the projections show positive trends, caution is advised as these improvements may be based on optimistic scenarios rather than stable growth conditions. It's essential to critically evaluate the assumptions underlying these projections. Understanding financial ratios is another insight. Understanding the implications of each financial ratio is vital for assessing the overall fiscal health and sustainability of the national budget. These ratios provide insights into the government's financial strategies and their potential impact on the economy.